Welcome back. Joining us on the show is David Lennox. He's analyst at Fat Profits. David, hi. Thank you so much for joining us. And I want to start with the crude oil prices first, where we have seen prices taking a good support. 3-month highs, $83 a barrel is here. And after 4 weeks of gains, this week as well has started on a positive note.
Well, look, yes, there's no doubt about it. We've seen that step up in the crude prices over the course of the last week. Primarily, we've seen a bit of action, unfortunately, in the Ukraine-Russian war, where we've seen it just perhaps escalate towards the Crimea and to deeper parts of that part of that country. That's, again, put some concern of geopolitical events back into the oil price. But the real key is that the China story, and there we've seen the authorities come out now and say that they will be in due course attempting to stimulate their country through various levers to get infrastructure going. And we do believe that that will allow the country to perhaps turn away from the current slowing growth that we've seen. And with that, we expect to see demand for petrol improve, and that should see the oil prices primarily continue to move to the higher side.
David, the other thing also is about the Russia and the OPEC and allies cutting output. That should also start showing into this quarter itself. What kind of tightness are you working with? And if you do believe that the crude prices will stay supported from here, what is the kind of upside that you're forecasting?
Look, certainly, yes, we have seen those cuts coming through, and OPEC has been very good over the course of the last couple of years in terms of living up to its promises. And this is another one where that is going to happen. Yes, we do expect to see the oil prices continue to move to the upside. We do think that they could probably breach through towards $100, but we wouldn't be expecting to see that in the near term. However, when one has a look more broadly, one would have to be still very careful of the fact that we saw lower oil prices because of global concerns over a recession. Yes, they've receded somewhat, but they are still bubbling away in the background, and that could put some headwind against any significant rally. However, we do think that there is probably circumstances building to see the oil price move higher over the course of the next few weeks.
So $100 eventually, but for the near term, if you look at this current quarter itself, is there a range that you're putting out for crude?
It's been very difficult to actually put some ranges around the oil price, because from time to time it has been quite volatile with some of the news that's coming out. We would be suggesting that instead of putting a range, we'd be looking more towards the trend being up, and that's the sort of strategy that we would be following in terms of buying into where we believe the oil price is going.
All right. How would you also look at the US Fed meeting that kickstarts today, and then you have the European Central Bank meeting as well, and both of these global central banks could be raising rates by 25 basis points. I mean, that is something that the markets have factored in, but it's going to be the future guidance that these banks come out with. What are you reading before the event begins?
Well, look, certainly when you have a look at the two banks, one would suspect that perhaps on the US side of the Atlantic, we will see perhaps a continued pause there. We do see that inflation in that country has come somewhat down, and significantly quickly. So that would give the federal bank some opportunity to just continue to keep interest rates on hold. Across on the other side of the Atlantic, we are expecting to see the ECB lift its cash rate by 25 basis points. They're not certainly at the same point in the cycle as the US is, and that's going to, we believe, cause them to act to the positive side. What we will see is a really significant move in the euro against the US dollar. That could cause the US dollar to weaken and be very good for the commodity prices in general.
Oh, well, absolutely. 101, where the dollar index is, does not augur well for commodities, especially the metal prices, where we have seen a decline. And that exactly is my next question. So coming in from China, while we have seen specific stimulus measures come in for automobiles and consumer electronics, it really is the real estate as a sector that the street is watching out for. Unless that doesn't come, the metal prices clearly have lesser impetus to grow on from here. How are you looking at many of these metals on a week-on-week and mostly on a month-on-month basis as well? We are looking at a slight positive in metals. But from here on, what would you want to watch, and any metal trade that you're willing to trade at this time?
Look, certainly we will be watching what China is doing in terms of pulling those levers to stimulate its country. We do know that they have a 5% target, and they will certainly be looking to achieve that target, and that's what we believe will be driving what they're going to do. That does require them, we think, to get outside of stimulating in the consumer area and looking at more broadly at infrastructure. We believe they're not going to do anything in the property sector. That's already well and truly, we believe, over-bloated with supply, and building more will just continue to extend that problem a lot longer. So we believe they'll move into the infrastructure. If they do that, that's still going to be very good for commodities, especially for steel. So if we see the US dollar weakening and we do see China starting to re-stimulate again, that's, we believe, going to be quite a good tailwind for commodity prices, and especially iron ore over the coming months. In terms of what commodities we'd be playing in, we still like the nickel and copper space. Copper has very critical inventory levels, and we're watching that very closely. And if those inventory levels are stretched any further, we could see quite a decent rally in the copper price. So overall, we're looking at copper, nickel, and iron ore.
Okay, a final question on precious metals then, and between gold and silver, where we are also looking at the global central bank meetings. What's your sense onto this one? Because we've seen the highs, but we haven't. We've actually formed a resistance around those levels right now from where we see it.
Oh yes, there's no doubt that the gold price is probably nudging up now of what could be a significant resistance level. However, if we are right, we do see the ECB lift its rates by 25 basis points, and the Fed stays on hold, then that's going to improve the differential to the euro, and that should see the US dollar weaken, which will give the gold price a little bit of a tailwind to perhaps nudge further away or towards the $2,000 level, and that's what we believe is going to be the key driver. Whatever the Fed Bank does in terms of holding, and if the ECB does lift, that's going to push the gold price, we think, through the $2,000 and probably beyond.
Okay. All right, David, as well as Manisha, thanks very much for joining in and bringing us your perspective on a whole host of commodities. But back to the equity markets, it seems as though the stock of the afternoon is going to be KPIT Technologies, which is surging after reports